Our next speaker is for the Central Region, Jeff Sanita, Senior Director, Cushman and Wakefield, Los Angeles. Thank you, Jeff.
This is not like rehearsing in front of your wife and dog, by the way. Central Region, just a little bit of background. It's 286 million square feet. The primary industrial markets or cities are the City of Los Angeles, City of Vernon, and City of Commerce. The makeup of the buildings primarily built between the 1940s and 1970s. I'm sure you've driven through and seen some of the beauties that are out there. Primary makeup, it's actually an interesting mix. You've got corporate America, you've got entrepreneurs, mom and pops, institutional owners. It's a real interesting mixed bag. Market stats, we talked about the inventory. You know, a lot of this are the same trends that we've seen for the last couple of years. Vacancy rate increased from 3.4% on up from last year. We continue to see negative net absorption from 2.1 million square feet, down actually from 3.9 the year before. If you jump down, obviously there was very little construction, and lease and sale prices went down, as we all know. I think the real interesting thing here is to look at in the middle at the total gross activity. We had 11.1 million square feet of gross activity. That's huge. 56% jump from last year. Leasing activity, which is direct leases, subleases, expansions on renewals, not renewals. That was up 7.3 million square feet and 345 deals. That was up 1 million square feet from last year. Sale activity, 3.8 million square feet and 41 deals, as you can see. That was up from 1 million square feet and only 23 deals last year. I think that's all. I mean, we're still talking about 2010, but it was very. Showed a lot of improvement. It was really good to see. Next slide, please. As far as the market overview, we talked about seeing the vacancy rates. They continue to go up. We saw continued negative net absorption, although if it's a correct term, it was less negative. We showed signs of that going down, and we saw a lot less on the givebacks. You didn't see big chunks of sublease space coming back. There weren't a lot of tenants walking from their buildings. It started to really show signs of shifting from the prior years. You go back, thank you. No, next, back. Landlords and tenants, we saw the gap between their expectations kind of close. What I mean is that tenants may have been sitting on the sideline and felt like, hey, now's the time to actually do something. Landlords are out there. They may have been sitting on their building for 6, 12 months vacant and said, hey, we've got to be aggressive and get deals done. And those two coming together led to this leasing activity. The rates weren't very impressive, and there were a lot of concessions, but it was still a lot of positive momentum. Same thing with the sales. We talked about the increase in sale activity, attractive financing terms. And interestingly enough, there wasn't a lot of inventory out there. Not a lot of REOs or givebacks that some of the people were waiting for. So I think it was time for them to jump out and take advantage while they can. We saw, as we had seen through this downturn, the food and the garment sectors, they continued to be strong while some of the other industries remained in flux. We saw the return of developers and investors on the scene. They had been, for the most part, dormant since the market went down. And you take all this and look at it together, it really seemed like things were starting to stabilize at the end of the year and that the worst was behind us. Next slide. So our lease deal of the year, I'll just pick out one. This is a A&B owned building in their Ford Distribution Center in Commerce. 139,000 square foot Class A building, freestanding, major street frontage, fenced yard, nice building. It leased to a shoe importer called Carini, and they leased it for 39 cents gross, which is much lower than you would have seen in the peak, although it did have increases up to 47, 47.5, 48, 50 in year 5. You had a couple months of free rent. A&B had done their standard great job of refurbishing the building. I think the interesting thing here is that this is an example of the meeting of the minds. I mean, A&B, I understand they had sat on the building for some time. That was ready to make a deal and kind of lead the charge to get leasing done. This tenant, we actually showed signs of consolidation. They came out of 2 buildings. After this happened, I think a lot of tenants and landlords looked at it and said, great, it's time to make deals, let's move forward. Next slide. This is a monster. This was the former Macy's Distribution Center as our sale deal of the year, 1.885 million square feet. The price that has not been confirmed but has kind of been circulated is $42 million, which we understand is this is the biggest sale in the region. From our research, it was back to 1994, but I talked to Don Hiroshi tonight, and he says it's the biggest user sale ever. So, thanks, Don. Another interesting thing on this was that it was really a massive consolidation and an expansion. And while they were going through this process, Forever 21, by the way, they were the buyer, huge growing company. They found out that this wasn't even going to service all their needs, so they ended up having to keep some other buildings to service their future growth. Next slide. So the 2011 market forecast, what are we going to see next year? It's going to be a year of transition. I don't think we're going to see a quick recovery, but we're absolutely going to see improvement. The overall vacancy rate, it actually leveled off from 3rd to 4th quarter of 2010. I think we're going to see that go down as activity picks up. We're at 4.2%, which is just historically low, so we're in a good shape as it is right now, even though it's ticked up a little bit. Rental rates will stabilize for the Class A product, 30-foot clear ESFR, Class A+. We think we're going to see rent growth in that sector. Class A and B and C space will probably remain flat. We don't see it going down. And as the A space trickles down, the pricing, we could see some growth in that area as well. It's a pretty simple formula. As you know, demand will go up. Available space goes down. There's no new construction. That should lead to a speedier recovery. And the last couple points, this is a big news downtown. I'm sure you've all heard about the new downtown LA stadium proposed, but it's making headlines and getting a lot of traction right now. I think that's really symbolic of the recovery of the central region. We're still going to follow the nation's path on economic growth and job growth, but we're on the right track. And last but not least, continue to stay positive. As you all know, perception becomes reality. Thank you.